Good morning, everyone. Thank you for joining our webinar this afternoon on strategies to protect your assets and minimize your tax liability. My name is Armine Bezikian. I'm a local estate planning attorney here in Los Angeles. I specialize in trusts and estates, and I help families and individuals plan for the unexpected. Bogdan Pagosian is also here with me today from Pagosian & Company. He is a local CPA and a former IRS agent of 9 years.
Hi, thanks for the introduction, Armine. I'm a CPA, like Armine mentioned. I was with IRS and I was CPA practice here in Glendale, and I specialize in small and mid-sized businesses. I provide tax preparation, tax planning, and business services like bookkeeping, payroll, and QuickBooks review. And mainly my area of focus is small businesses and mid-sized businesses. I also specialize in IRS representations, IRS audits, and any IRS problems.
Great. We have a really good webinar for you today. We're going to be talking about how to keep your assets basically in your pocket and away from potential creditors or existing creditors or even the IRS. So our goal is going to be to provide you with a little bit of education in the small amount of time that we have. If you have further questions or detailed questions or private questions you want to ask us, feel free to shoot either one of us an email or call us. We both provide free consultations, so feel free to call us and we'll chat about your specific issue. This webinar is going to be recorded, so we will be posting it online, and you will also receive a copy of it. So feel free to reference it and share it with your friends and family that you might think might find useful as well. We have received a few questions ahead of time. If you do have questions additionally, go ahead and email it to us, and we'll make sure, if we have time, we'll try to answer them. If not, we'll get back to you after the webinar is over. We'll try to get back to you within the next day. So let's get started. We've prepared some slides for you to help you kind of go through this motion with us and provide some visuals. So I'm going to start the slides right now. And here we go. So I'm going to start off with asset protection and kind of go over what it is and what it entails, and etc. So, you know, not a lot of people know what asset protection is. Asset protection is essentially structuring things, structuring your existing assets in a way that's going to protect them from future risks. So the entire premise is we don't know what's going to come up in the future, but we're going to try to protect you from any potential creditors that might come in and try to take your existing assets. There are certain circumstances where there's already an existing lawsuit, for example, pending against you, or somebody might already have a judgment against you. So there are asset protection techniques that can help for those individuals as well. But the entire premise is to do this way ahead of time before you get into any trouble at all. So, you know, some examples of asset protection tools, which you may have heard of, are, you know, family limited partnerships, LLCs, irrevocable trusts, foreign trusts, and there's a variation of other tools that are available to you to be able to protect you. This area is the fastest growing area of the law, and the entire premise is to shield whatever you own from the hands of somebody else that wants to get to them. The goal is not to hide assets from creditors or evade taxes. There's nothing illegal that, you know, you should attempt to do. Everything is within the parameters of the law and you know, tested in true methods, pretty much. So according to California collection laws, creditors have certain rights against you when they want to collect a debt that you owe to them. So let's assume that somebody has sued you and they have a judgment against you. We know that judgments are good for a certain number of years. They're good for 10 years in California, but even then they can go ahead and renew it against you. And according to the California Civil Procedure, section 695.010, all property which is owned by the debtor is subject to subject to certain exceptions, is subject to enforcement. So they can come after everything you own. And the caveat is they can also come after everything that your spouse owns if it's considered community property, depending on how you hold title to certain assets. So you have to really be careful about, number one, the classification of your asset, how you own it with your spouse if you're married, and whether or not the creditor can get to it. So some of the methods that a creditor can use, so let's say they have the judgment, they know, where you live, and they want to come after you and get their judgment fulfilled somehow. What they can do is if they own, for example, if they know you own real property, and that's pretty easy to find out. They could just do a search of the county records. They can easily put a lien on your personal property or your real property and simply, collect against it when you sell, or they can foreclose on your property. A lot of people think that for some reason their home is sacred and the creditor can't get to it, but that's not the case. Yes, there's a homestead exemption that you can file that'll protect you up to a certain limit, but if you have equity within the home above and beyond that homestead exemption amount, you can very well be subject to a foreclosure sale by a creditor. So they can also execute a writ of execution. The sheriff can collect the property, sell it, and then turn over the funds to the actual creditor. They can also apply for the court to obtain a turnover order. So the turnover order will essentially say, so-and-so, you are now hereby ordered to turn over the vehicle which you have not paid your loans on, for example, and you're obligated to turn over the car on such and such date. The court can also direct the debtor to subject the debtor to a debtor's exam. And this is a scenario where the creditor doesn't know anything about where you own certain assets, how you hold them. So what they do is they call you to court and they will literally ask you questions about, where do you bank? What city do you bank in? Which branch do you bank in? What assets do you have? So they can ask you whatever questions they pretty much want, and you have to answer because you're under oath. So that's how they find out about what you have, and then they come after you for it. They can get a charging order against an LLC that you own, and they can always garnish your wages, which is probably the most popular method that people think of, is they can collect up to a certain percentage of your wage. So they will send it directly to your employer. Your employer is obligated by law to comply with the wage garnishment order, and there's pretty much nothing you can do about it. So these are just some of the methods. So what can we do to protect you from these creditors that are going to come after your hard-earned assets that you've probably worked years and years to accumulate? Well, it all depends. There's certain layers of protection and certain techniques. There isn't one that's better than the other. It's a combination of a few of them that together, taken as a whole, will provide pretty much the most protection. So for example, if you're married, there are certain things we can do before we turn to different asset protection vehicles that can actually help. So in California, which is a community property state, a married couple that acquires property during their marriage will classify that asset as community property. So it's going to be considered community property if you purchase a house during your marriage, for example. And the key to know about community property is that the creditor of one spouse can reach all community property of the other spouse, which is pretty significant. So, if your husband gets into a car accident or does something negligent, your entire community property asset pool is subject to that debt. There's also what's called separate property, and this is when you own property that's individually separate and it's yours. Your spouse has no interest in it. And these are things, this is an asset that you may have acquired prior to marriage. It's an asset that maybe you inherited or received as a gift. You don't have to share those with your spouse, which is awesome, right? Yeah. So if you got an inheritance or a gift, it's your separate property. Once you share it with your spouse, it becomes community property. So remember that. So it also could be things that you did buy during your marriage, but you mutually decided that it's going to stay separate. You wrote up an agreement that this is my separate property. So the key about separate property is that one of the creditor of one of the spouses can't reach the separate property of the other spouse.
Does the agreement have to be the time of purchase of the property?
It would be best that it would be, either right before or at the time of the purchase. You can also enter into an agreement that will be after, and we'll talk about more about that. It'll be called a transmutation agreement, where you'll shift things. So something that would have been considered community property, you all of a sudden decide this is separate property. The best time to do all that is, of course, before you get married. So I'm going to give you an example. For example, let's say Harry and Melissa live in California, and Harry owns a piece of real property. He had a bachelor pad before marrying Melissa, and Melissa had nothing before marrying Harry. She didn't bring any separate property into the marriage. But during her marriage, her uncle dies and leaves her $100,000 cash. They have no prior or post-nuptial agreements between them. They just had their wedding and that was it. And then after they were married, they purchased their home and that's where they lived. So Harry's separate bachelor pad, he decided to rent out, let's say. So if Melissa gets into a car accident, she's a terrible driver and is sued, her creditor would only be able to satisfy that judgment against her inheritance, because that's her separate property, and her home, which means the creditor can get to the entire house, even Harry's community property interest of it. But the creditor would not be able to get to that bachelor pad because Harry's separate property and he kept it that way throughout the marriage. So it's always a good idea if you're somebody that's high risk, that you're contemplating being sued in the future, you're just in a high risk industry and you're going to come face to face with potential creditors in the future, that you enter into a premarital agreement. There's different purposes for a premarital agreement. I know the most popular is the thought process that you want to keep what's yours and away from your spouse in case they divorce you. But, other couples might enter into a premarital agreement for the sole purpose of protecting assets from creditors, from third parties, not from the other spouse. So if you kind of missed that boat and already are married, you can do a postmarital agreement that can also provide some help. Or you can actually enter into a transmutation agreement if that applies to you. And so this is what you were asking me. So what Harry can do is, or what, in that scenario, what Melissa can do is that separate property inheritance that she got, she can actually convert it to community property. So she can deposit it into a bank account that she has with Harry, and they can sit down and write a transmutation agreement that says, I am now giving my property to my spouse. So that if, for example, it would be the other way around, Harry would get sued. It just depends on who has the potential to be sued, but basically you can protect yourself. She can very well transmute that inheritance, that entire $100,000, and give it all to Harry, and it'll become his separate property. She won't have any interest in it. So that during that lawsuit, she can say to the creditor, I don't have that inheritance anymore. I transferred it over to my spouse. Now there's always risks with that because, number one, Harry can just divorce her and it is going to be considered his separate property. So there's no argument that she can't go back and say, I didn't intend for it to be like that. And there's also a potential for Melissa to be subject to what's called a fraudulent transfer action. So the creditor can argue that, you knew I was coming after you, I had a judgment, you transferred it fraudulently, and you did something bad. It's a slap on the wrist. However, just because of the word fraudulent doesn't mean that you're committing fraud. And further, I want to emphasize that not a lot of creditors will come after the person, but that's an extra step for the creditor to take. So they have to basically charge you with fraudulent transfers. So there's a chance actually that the creditor may not come after you at all. There's a chance that they might come after you and for fraudulent transfer, and you can argue that you didn't and defend yourself, and they won't be successful on that action. So it just depends. If you're in a situation where you're about to lose the only asset you have, and it's your home, and you're 70 years old, and you rely on that, and you have no other family or nowhere to live, then what risk are you? The risk is very low, right? To transfer it into an irrevocable trust and risk being accused of doing it fraudulently. You're going to lose that property anyway. Why not try? So
and that's where you come in,
right.
You can assess the situation.
Exactly. So it's a matter of kind of taking the risks and the potential risk of the actual asset protection method and seeing if it'll work out for your favor. So a transmutation agreement is a great tool, and we can always get around the fraudulent transfer as long as both spouses have equal assets. That's one of the arguments that it's not a fraudulent transfer. We both get equal stuff. It's just that she gets that stuff that you really want. creditor. Sorry. So I'll give you an example at the end on the different scenarios that we're talking about. And then, of course, divorce is always a tool that you can use. You can divorce your spouse and you won't have anything, so the creditor will come after you for nothing, but that obviously has certain risks. So you should obviously be careful with that one. You have to be in a very committed relationship for that one to make sure that your ex-spouse at some point gives your assets back once you're done dealing with your creditor. So I'm going to kind of speed it along. A lot of these concepts are a little too convoluted to discuss in a short amount of time that we have. So I'm going to go through them very broadly. There's like 20 to 30 techniques that you can use to protect your assets. I'm just going to highlight the most popular one. You can create a trust of some sort, whether it's a spendthrift trust, a foreign trust. There's a whole list of trusts that you can create depending on the different scenario that you're in. For example, you can create an irrevocable trust, and you can, I know a lot of people will go the revocable route because they don't want to take away their right to revoke the trust. But if you are in a situation where you have a creditor against you, for example, like the 65-year-old lady with the only asset being her, $500,000 home, she can very well transfer it into an irrevocable trust. Once she doesn't have that power to get the asset back because it's irrevocable, she can't undo it, then the creditor can't get to that asset. So she'll be in a situation where it'll be in the irrevocable trust. The only risk to her is who's controlling that trust and are they keeping it for her benefit? Well, we can simply make sure that she has a trust protector within the trust, and it's somebody she assigns, and we can give her the power to remove that trust protector. And the trust protector can have the right to do all the things that she would normally do in the trust. Okay. So, for example, you could be my trust protector in my irrevocable trust, and you'll be the one in control of everything. So when the creditor comes after me, I don't have the right to revoke it. I don't have any rights. Vaktan over here is controlling everything for me. And so far in California courts, this trust protector concept has been upheld. It's a very new area of the law, so we haven't had any, there hasn't been any backlash yet. So it's a really good tool. And then I can maintain the power in that irrevocable trust to replace you. So if you don't like something and you're not doing something I want you to do, I can just replace you with somebody else that'll do the job for me, whether it's a family member or a friend or somebody. There is a little test that you have to make sure that it's not somebody that you're in an agent principal relationship with. So there's a few rules that you have to follow for that. It has to be a specific type of person that you assign as trust protector, but it's an amazing tool that you can use. So you can also create a type of entity, whether it's an LLC, corporation, family, limited family partnership, limited liability company. It just depends, and all of these have different advantages legally and different disadvantages, and they have the same tax-wise as well, which Vaktan will talk about later. But I want to compare corporations and LLCs just to give a broad picture. For example, if you're involved in a car accident and you have stock interest in a corporation, your creditor can come after your stock interest. It's an asset. They can literally come after it and have you transfer it over to them, or it'll be sold and they can get the money from it. Whereas in an LLC, it makes it a little bit more difficult for them to come after your membership interest. They cannot take your membership interest in that LLC. They can only get what's called the charging order, as I mentioned, against your economic interest, which means when the LLC distributes profits to you, that's what they get. However, if you have an LLC with your brother and your cousin and your friend, and you guys are the only individuals in the LLC, you can choose not to issue profits that year if you know you have a creditor waiting on your heel. And that's a really strong tool to have, that ability to stop the payments, because you can literally approach your creditor and say, I have the power in this LLC. We're just not going to issue any profits for the next 10 years if that's what it takes to get you off our back. And maybe you can negotiate with the creditor and lower the debt that you owe to them and make them go away. So these are all asset protection tools, but that are designed to put you at an advantage with your creditor, to give you the upper hand so that you're not the one that's fearing the creditor. You corner the creditor, they have no other options, so they have to negotiate with you and they have to take whatever offer you're pretty much going to give them, or they're not going to get anything at all. You can implement poison pill clauses within the LLC, and these are just clauses where if the creditor becomes a member, other members have a right to buy his interest at a very nominal rate so that they have no motivation to get themselves involved in your LLC. You can create a type of LLC that will give you privacy so the membership lists won't be released. For example, in California, you can easily ascertain who the members of an LLC are. Whereas if it's a Delaware LLC, it's the most private state so that you cannot find out who's a member of the LLC. So, and then there's also retirement plans, which are a good tool. ERISA qualified plans are protected from creditors if you follow certain rules. Like you must have a non-owner employee vested in the ERISA plan for it to be protected. So what you could do is if you have $200,000 and it's cash, it's sitting in an investment account, and you're scared your creditor is going to get to it, you might think about investing it in a qualified plan if you have that ability, because then it'll be kind of locked down and the creditor can't reach it. Whereas, IRAs are not protected, and there's certain exceptions to that I won't get into, but you could just see the difference. So let me go through my example, and then I will we'll let Vartan talk about his minimizing tax liability techniques. So, for example, let's assume husband and wife are married. Together, they own their home worth $500,000. The husband has separate assets of his own. He has an apartment building. He has an account with Charles Schwab. He has his retirement account, and he has a cabin. So the wife has no separate property assets at all. So let's assume that the husband is involved in a lawsuit with a very large judgment against him, and his insurance is just not enough to cover it, and they're going after him personally. One of the first techniques we can utilize is a transmutation agreement between the husband and wife, where we can kind of shift some of the husband's assets into the wife's separate property. And remember, to overcome the argument of it being a fraudulent transfer, what we're going to want to make sure is that it's equal across the board, that they have, at the end of the day, they both get the same amount in dollars of the assets. So, the home, the investment account, and the cabin, which totals about $1.5 million, we can put into the wife's name as her separate property, and the husband can just keep the apartment building and the ERISA retirement plan. So it'll be $1.5 million to her, $1.5 million to him, and then that'll help us kind of overcome the fraudulent transfer allegations, because the transmutation is completely equal across the board. So, let's just assume that the husband needs obviously further planning, because he still has a lawsuit and he has his apartment building on the line. The ERISA account we know is protected, so, we're not worried about the ERISA account, but the apartment building, we want to explore different options. Can we sell it? Is he attached to it in any way? If we can sell it and invest that money into an account, a foreign trust, where the creditor can't get to it, that might be the best bet. If he doesn't want to sell it, we can maybe put it into, as I said, just put the apartment building in a trust, not the cash. Put it in a trust or a different entity, maybe an LLC. That way it'll just be protected with the LLC, and the creditor will have to go through the slew of charging orders. And then maybe we can put it in the LLC and do an asset equity strip where we can borrow against the property so that there's no equity left at all for the creditor to get to. So there's a whole list of things we can do to make sure that no one's touching this apartment building, and that we'll put the husband at an advantage to approach the creditor and say, let's negotiate. You're not getting anything. So, that's what we can do for those two assets, the ERISA and the apartment building that are now the husband's. But what about all the stuff that we gave to the wife? Let's say she's a crazy driver and she ends up needing some additional planning. Well, we can easily put the home into an irrevocable trust, like I mentioned, which I would recommend. That would be the best bet. And then the cabin, it's a vacation home. They don't use it that often. Easily put it into an LLC. It's real property. It's a perfect candidate for an LLC. And I think you'd agree on that from a tax perspective. And then the investment account, again, that could go into an irrevocable trust as well, with, of course, a trust protector to make sure that everything's taken care of. So at the end of the day, the creditor hopefully will not be able to get to anything. And then hopefully they won't get a divorce, so it won't be more messier than it has to be. So that's pretty much what I have to say, and then we'll get to questions at the end, but I want to give the floor to Vartan to talk about how to limit your tax liability.
Thanks, Armina. That was very informative. And just to kind of give you advice for all the listeners, that the planning is key, right? Right. So it's important, ahead of time to, let's say if you have a creditor knocking, or just don't take any action. See your attorney first, and you can call Armina and talk to our plan. Planning is the key for both asset protection and tax liability. Let me jump into my section. First topic I want to talk to you about today is net investment income tax. It's a new tax that came about in 2013 when it was first introduced. Obama administration introduced it as tax to wealthy. But when you get to the bottom of it, it's not exactly the case. But let me tell you what is subject to net investment income first. Basically, if you have any dividends, interest, annuities, royalties, rent income, and gains from disposition of property, you might be subject to net investment income tax of 3.8%. And here are the thresholds on your screen. You can see if you're modified adjusted gross income, I'm not going to go into details what that means, but in layman terms, basically your income. If your income is $250,000 or more for married filing joint returns, you will be subject to net investment income tax. For single filers, the limit is $200,000. So, and married filing separately, $125,000. So if your overall income is in excess of this threshold, you will be subject to net investment income tax. Let me run a really quick example here. It'll show you like how this tax applies. In 2014, for example, if Anna is a single person and she earns a salary of $140,000 and she has a $90,000 in interest income, she will pay NIT. We're just going to call it NIT for net investment income tax. She's going to pay NIT as follows. So her Maggie is $230,000. Her salary of $140,000 and her interest income of $90,000. The threshold for her is $200,000. If you recall from previous slide, that's the threshold for single people. So she has excess of $30,000 over threshold. The law says you have to take the lesser of excess and her investment income, which is $30,000, and she's going to pay tax of 3.8% on that $30,000. So that comes to about $1,100 in tax. And of course, if you have rental income or if you disposed of a property in that year, your net investment tax could be much higher amount. So some tax planning tips to avoid this tax. One of the main things, if your property that you dispose of does not qualify for personal residence exclusion, you can do what's called 1031 exchange. A lot of you might have heard about it. 1031 exchange is basically you're replacing your property with another property. So if you have real estate, a rental real estate, for example, you sold, if you buy another real estate, you're allowed to defer the gain. So basically, you transfer the gain to new property, and you can do that indefinitely. You can keep buying properties and keep deferring the gain till forever. So that's a great tool, great tax planning tool. Another is sell property on installment method. So basically, you're going to defer not only the net investment tax gain, but you're also going to defer part of your capital gain through installment method sale. And another thing to consider nowadays is investments in municipal bonds. They're completely tax-free for federal purposes, so you don't pay tax on investments in municipal bonds. If you're involved in real estate, you might want to establish yourself as a real estate professional. And what that means is you don't have to go out and get a realtor license. But what it is per the tax code, if more than half of your time is spent in real estate, and if you spend 750 hours in each rental property, you are a real estate professional per the tax code. And what it's going to allow you to do is it's going to allow you as a real estate professional to avoid the net investment income tax on your rental income, or if you dispose of any property, the gain will not be subject to the 3.8% net investment income. Plus, you will be able to deduct your rental losses in excess of the $25,000 limit that applies to everyone else. So let's say if you have a rental, and you're not a real estate professional, you can only deduct up to $25,000 in rental losses, assuming you're actively participating in your rental activities. But if you are a real estate professional, you can exceed the $25,000. Let's say you have 4 properties,
right,
and you might have $60,000, $70,000 in losses due to mainly depreciation. If you're treated as a real estate professional, you can deduct those losses, and then when you dispose of the property, you're not going to pay the 3.8% net investment income tax. But again, the rules are complicated and tricky, so it's important to see a CPA who knows who knows all the rules of real estate professional. As a former IRS agent, as an IRS agent, I audited many tax returns with this issue, so I know what the IRS is looking for.
And you specialize in the real estate?
Yeah, I specialize in real estate industry, pretty much investors, owners, realtors, and everyone who's involved in real estate.
So would literally going over to your rental property and collecting the rent, would that fall into the number of hours that you spend? So essentially managing your rental property?
Yeah, to get the $25,000 loss allowance, you have to actively participate. The law doesn't really define what activist. There is no law. There is no hour requirements. But if you want more than $25,000 deduction, you have to meet the real estate professional requirements. And
you can do that if you have like 1 property.
Yeah,
assuming if you have a lot of.
Sometimes it's hard to meet more than half of your time. That's like let's say you're a full-time employee. Yeah. It's really hard to be a real estate professional. But if you're in business of investing in real estate, it's possible to meet the test. Again, it's on case-by-case basis, so it's best to schedule a consultation with a knowledgeable CPA. And also, what a lot of people don't know, if you're not materially participating in the business that you own, for example, you might own an S Corp or partnership, and you're a passive shareholder or passive partner. Your income from those interests might be subject to the 3.8% net investment tax, and that's a big thing. A lot of people are going to be hit with, and they don't realize. But if you're materially participating, if you meet the 500-hour test, you can exclude you can avoid the 3.8% NIT tax.
And this is any type of business, right?
Yeah, any type of business, yeah. Also, you can lend money to your business, which generates interest income, and this will not be subject to NIT tax because there are self-charged rules that allow you to exclude from this tax the interest income.
I just want to stress that, if you are going to partake in one of these methods, especially the lending money to your own business, that you absolutely talk to a CPA first, because a lot of people will think, okay, I'll just lend the money and pay myself monthly. But you got to make sure that you follow the interest rate at the time, depending on if it's a short-term loan, long-term loan. Everything changes based on how you're going to structure the loan. It has to be in writing, definitely from a legal standpoint, but your CPA will know how to structure the loan so that you're benefiting from it without paying too much in interest yourself.
Yeah, definitely. Good point.
It's not something you do on your own, pretty much.
Yes, definitely. And also, if you have a business and you have, big rental expense, you might want to consider just investing in property, setting up an LLC maybe, and then renting it from your LLC. And the self-charge rules will apply. You will not pay the 3.8%. Plus, you can generate losses from the LLC for tax purposes. You can do segregation studies and maximize your depreciation. It's a great tool, and you're actually your spouse can own the LLC and qualify for professional, because if you have a spouse who is not working, for example,
take advantage of that.
Take advantage of that. Treat her as a real estate professional, because her more than half of service time will be met very easily, because everything she does will be real estate, and she can easily meet the 750-hour test. and she can own the LLC, and basically sky's the limit. The losses will not be limited. And then the income from the rental income on LLC will not be subject to 3%.
So for example, if I were to purchase my own office building that's a self-contained small building, I can create an LLC, transfer the property into the LLC, and then my S Corp legal corporation can rent the properties, the space. So it's a pretty simple structure when you kind of go through it, but not a lot of people know about it. Not a lot of people, I think, take advantage of it.
Yeah, and the LLC will create, it's a loss generator because of the depreciation.
Right.
Okay. And then another strategy is to pay as much as possible to your CPA and attorney to generate the investment expenses to offset the investment income. And
that's our joke for the day.
That's our joke for the day. Yeah, we don't get much funnier than that as CPAs and attorneys. So that was a joke, people. So next topic I want to talk to you about is capital gain disposition of property. So people sell properties. It's common, and they basically try to do things after the fact. Well, I sold the property. How can I minimize the gain? Well, it's pretty much too late at that point. So what I want to emphasize here is just like I was emphasizing earlier with Armine, the planning is the key. Like it's key to talk to your attorney when it comes to asset protection, and it's key to talk to your CPA before selling your property. So if you have a property you're contemplating to sell, it's important to see your CPA prior to the sale to plan it, because there are some options. In this case, for example, if you don't qualify for personal residence exclusion, you can sell your property through installment agreement, and you're going to pay only on the portion of you're going to pay tax on the portion of the payments you receive. So for example, if you had a building that you bought years ago for $600,000, now you're selling it for $1 million. Your profit is 40% of the sales price. So you're going to pay 40% tax, capital gain tax on the payments that you receive. So let's say if you receive in that year 20,000 payments, you're going to pay tax on the 40% of that amount. So
you're basically dividing it across
future
tax return.
Of all payments. So you're deferring basically your gain for over the time of the installment agreement. Another alternative is again 1031 exchange. Some people say, well, how do I find a buyer who is who we're going to do an installment agreement? 1031 exchange is a big tool to minimize the exposure to capital gains.
So when should somebody kind of see you? How many months before they decide to sell?
Yeah, as before putting the property even on the market, it's important to see
explore
the
these
CPA.
different
Yeah,
options.
explore all options, because for example, with 1031 exchanges, the replacement property must be bought within a certain amount of time. You have to identify within 45 days of the sale your property, and you have to close within 180 days. So it's all time sensitive. So you don't want to sell your current one without planning, because if you do, then you'll be at really time crunch, and you don't want to buy a replacement property just for the sake of qualifying, because sometimes it's hard to find properties that you really like. So next, I want to talk to you about this entity structure. A lot of questions I get when I have business owners come in for consultation. Do I become an LLC? Should I form an S Corp, partnership, C Corp, sole proprietor? These are the questions that business owners always have. But today I want to talk to you about two of the choices, LLC and S Corp, because a lot of times what I find is these are the most common ones, and actually the combination of both most of the time is the best bet. First of all, each entity type might be suitable for different type of businesses. So there is no clear-cut answer as to which entity type is better, because It varies from industry to industry. It varies on the number of shareholders or partners you have in business. So it really takes, knowledgeable CPA to really ask you all the right questions to really come up with the right solution. But I want to just talk to you about the most common ones, LLC and S Corp. So let's talk about the advantages of LLCs. LLCs, like Armina mentioned, is a big tool to protect your assets. It's a great asset protection tool. It allows flexibility in allocating profits and losses among members of LLC, and it's really easy to operate. And you can easily add new members to LLC, take out members from LLC, as Armina was mentioning earlier. It's really a flexible tool. It has some disadvantages from the tax standpoint, like single member LLCs are disregarded for tax purposes, and the income is subject to self-employment tax. Basically, if you're a single member LLC, if you didn't make any elections, you don't have partners, just you're one person LLC, for tax purposes, you're going to file the LLC income and expenses with your individual return, and you will be subject to self-employment taxes.
So what should somebody do that's in a single member LLC and they don't have anyone else?
That's my next topic, which will cover, the combination of S Corps and LLCs. So tax on gross receipts, which means you might have losses for your business, but you'll still pay tax. Basically, in California, if you have an LLC, you're taxed on your gross receipts. So whether irrespective of your expenses. So you might have a net loss in your business, but if you're taxed on your gross receipts. And again, there is a way out of it. We'll talk about it in a second. California also does not allow LLCs for professional services like attorneys, CPAs, architects, doctors, dentists. They're not allowed to form an LLC in California. So that's, if you're in professional services, LLC is not an option for you. Next, I want to talk about S Corps, and I'm going to bring together S Corps and LLCs together. S Corps are pass-through entities. What does that mean? It means that S Corp does not pay tax in itself. So all the income from S Corp is passed through the shareholders, and shareholders are going to pay the tax. S corporations can have up to 100 shareholders, and all of whom must be individuals, estates, or certain trusts. One of the advantages of S Corps is it allows you to reduce self-employment tax. And basically, the net income from the S Corp is passed to the shareholder, and the shareholder is paying the federal income tax on that amount. Yeah, here it is.
Sorry about that.
So shareholder is paying the federal income tax on that amount. And also, S Corp allows you to shift income to lower tax brackets. So for example, if you have a family member who is in a lower tax bracket, you can assign shares to the family member and minimize your taxes. And another big thing with S Corps is you can reduce your audit risk. What do we mean by that? Basically, if you look at the statistics, IRS in 2012 audited 3.5% of all Schedule Cs with income of 100,000 or more. So if you compare that to S Corps, only 0.5% of all S Corps were audited in 2012. So 3.5% for Schedule Cs and 0.5% for S Corps. Well, you might say 3.5%, 0.5%, those are small numbers. But if you just compare the two, that's a 7-fold difference. Like 0.5% and 3.5%, that's a huge risk difference. So you might say, well, I don't care, my books are clean, why should I worry? But IRS audits are very costly. costly and time consuming. So if there's a way to reduce your audit risk, why not? So those are the advantages of S Corp. So next, what I want to talk to you about is best of both worlds. So we talked about the advantages of LLCs and S Corps and disadvantages. What I like about combining these two options is you just take the best of both worlds. If you form an LLC, you can make an S election after forming the LLC. So if you start your business, you go to Secretary of State in California and you form an LLC. Once you have an LLC, you file with the IRS an S election. And what it does is it keeps your LLC status with the state, and you file with federal as an S corporation. So you keep all the advantages of LLC, asset protection, ease of operations, and all the good things that Armina was talking about when she covered the LLC section. So you keep the flexibility of LLC, and you reduce the self-employment tax, which was the advantage of S Corp, and you reduce the audit risk rate. So to me, the combination of LLC and S Corp is a perfect scenario, because you're keeping all the good things about LLC and all the negative aspects of LLC when it comes to taxation. You're minimizing all those negative disadvantages of LLC by forming an S Corp. So the self-employment tax issue, the audit risk issue, they're all minimized when you form an S Corp.
So I'm going to jump in and ask you a question that we were emailed. If somebody formed an LLC, let's say a couple years ago, and it's a single member LLC, can they go ahead and do the S Corp filing today?
Yes, they can file an S Corp. What IRS rules require is you have to file the S Corp status election within 90 days of the effective date that you want the S Corp to be filed. So let's say if you want as effective date January 1 of 2015, you would have to file within 90 days of that date. IRS does grant sometimes a late election request. Most of the time they do grant. Let's say if you pass the 90 day, but you still can file the election request, and most of the time they'll grant it if you have like a reasonable cost.
So what would be a reasonable cost?
You know, miscommunication with CPA. You can put that
Blame it on the CPA.
Yeah, blame it on CPA. You know, I told my CPA, but you know, there was a miscommunication.
Okay.
Yeah. So, and yeah, there is nothing preventing you from filing an S Corp status after you form your LLC.
Okay.
It's just a matter of the effective date of S Corp. So you can have like a retro, go back 2-3 years. And
right. It would just be from this moment on.
Yeah, from that moment on, and they will grant within the year. They will grant you the late filing.
So we have a few questions. That was one of them. But let's see here. So I asked that question. So the next question we received was about transmutation. And the question, I guess, is when you transfer a property to your spouse, a separate property, do you lose the step up in basis?
Oh, okay.
And so I think it's a tax question, but I think I should answer that question. I mean, you do, pretty much. That's a risk that you're taking. So if you want the advantage of not owning that asset to protect yourself from creditors, then you can't take the advantage of having the step-up tax basis. And what, I don't know if many of you know, but what a step-up tax basis is if husband and wife own a property, let's say their home, and husband dies, and at the time of his death, the property was valued at $500,000. What the wife will be able to do is obtain a step-up in basis, which means, you know, the $70,000 they paid for the house in the 70s is going to be ignored, and her new basis for capital gains purposes is that $500,000. So if she turns around in 10 years and sells it for $1 million, they're going to only calculate her capital gains from that 500,000. They're not going to go back to the 70,000 they paid in the 70s. So, you know, if you transfer it out of your name and you give it to your spouse, you're necessarily going to lose that step up in basis. So it's a disadvantage, but I think it's, if you have a $2 million judgment against you, you know, there's nothing else for you to do. And then the other question was about property taxes as they relate to having an LLC formed. And so what happens with your property taxes if you transfer something into your LLC. So when you do that initial transfer, if I own an apartment and I want to transfer it into an LLC to get all the tax benefits that Vasan talked about, as well as all of the asset protection benefits, the initial transfer to the LLC will not be reassessed for property taxes. So your property tax will stay the same. However, there is a rule that says essentially if in the future you transfer it, let's say I'm the only member of the LLC, and all of a sudden I want to gift half of it to my sister. That 50% that I'm transferring to another member, I'm bringing on a second member of that LLC, a second owner, if you will. If it's 50% or more, then the entire property will be reassessed for property tax purposes. So if you are going to form an LLC and you have intentions of attracting investors into the LLC or whatnot, and you have real property in it, you have to be careful about that. So you know, make sure that you discuss that with your attorney and CPA. So that pretty much concludes our presentation for you guys. If you have additional questions, feel free to contact either one of us. You had our information up on the screen, and I will put it up again. Thank you for joining us. Oh, I guess I closed it. No, I didn't. Thank you for joining us. We had a, okay, I don't know, but you guys can contact us. You know where to reach us. My phone number is 818-649-9110. And
my number is 818-396-0705. I just want to add that planning is a key.
Pre-planning, ahead of time.
Yeah, pre-planning is a key for pretty much everything we talked about today, whether it's asset protection, tax minimization, investment tax, and all the things we talked about. Planning is a key.
Definitely, you want to think ahead of the game, and you want to, you know, basically get everything done now so that when you are in a sticky situation in the future, you're on cruise control and you're not worrying and you're thinking straight on how to deal with it rather than running around frazzled trying to figure out how to deal with the problem. So thanks for joining us again, and we will hopefully do more collaborations in the future and provide you with more education and knowledge on these different issues. If you have suggestions on what you want to hear about a specific topic, if you have a suggestion for Vartan or myself, go ahead and email us, and we'd be glad to, you know, do a webinar on that, whether it's individually or together. Feel free to email us.
Okay.
Thank you for joining us.
Thank you.